Silver closed March 3rd at $81.40 per ounce, down 9.7% from February 27th. Yet 5,087 contracts delivered through March 2nd, representing 48.3% of standing open interest, with 43.1% delivered on first notice day alone. Registered COMEX inventory stands at 86.13 million ounces. May 2026 open interest, 394.6 million ounces against that same 86 million registered. A 4.6 to 1 ratio. This is the behavioral divergence. Paper liquidation meeting industrial frontloading. March 3rd. Intraday, 96.66 to 83.04. Down 15.26 in 12 hours. CME margin requirements as of February 6th. 18% maintenance for standard accounts. Initial margin also 18%. Zero buffer. Any adverse price movement creates immediate margin deficit because account equity falls faster than the dynamically adjusted maintenance requirement. Higher risk profiles carry 19.8% initial versus 18% maintenance. A $1.74 per ounce buffer before forced liquidation. At peak notional of $483,300 per contract, standard accounts held exactly $86,994. When silver dropped $1.66 to $95, maintenance requirement recalculated to $85,500. Account equity, $78,694. Deficit, $6,806. Immediate margin call. This explains the violence of the cascade. The delivery data confirms industrial panic. February 26th, first notice day, 4,540 contracts delivered. February's first notice day, 1,881 contracts. March. Day 1 was 141% higher. Days 2 and 3 reverted to 2 to 3% daily delivery pace. This pattern, extreme front-loading followed by normalization, signals a discrete industrial cohort securing immediate physical, not speculative positioning. Lease rates, 8.2% as of March 4th. October 9th, 2025, they spiked to 39% when India's 1,000-ton order froze the London spot market. Emergency air shipments of 15 to 20 million ounces from U.S. warehouses brought rates down to 5.6% by late October. But persistent 6+% levels through February confirm structural tightness. For context, normal lease rates run 50 to 150 basis points. Current rates are 5 to 6 times normal. JP Morgan's house account holds 133 million ounces, more than the entire registered COMEX vault. The 8.2% rate reflects strategic withholding ahead of May's delivery wall. Forward swap rates dropped to negative 7.09% in December. Buyers paying interest to acquire physical immediately rather than waiting for futures delivery. The vault treadmill. Conversion rate 500,000 to 1 million ounces per day, eligible to registered. Withdrawal rate 785,000 ounces daily. Net registered decline 2 to 300,000 ounces per day. Conversion barely keeping pace with exits. Private eligible holders refuse to convert despite 8.2% yields. They fear May force majeure scenarios where registered metal gets cash settled, leaving them with paper instead of physical. March 5th. Delivery data determines whether May 2026 faces manageable conversion or systemic failure. The two-tier market has materialized. Paper at 84.81. Physical premiums at 12% depending on jurisdiction. May's open interest versus registered inventory is the real stress test.